The stock market. It's a term that conjures images of frantic trading floors, flashing screens, and fortunes made and lost in the blink of an eye. But beneath the surface of this seemingly chaotic world lies a fundamental engine of wealth creation. At its heart, the stock market is simply a marketplace, a place where buyers and sellers come together to trade pieces of companies known as stocks or shares. Think of it like a giant auction house, but instead of paintings or antiques, you're buying and selling ownership in businesses. When you buy a share of stock, you're essentially becoming a part owner of that company, with a claim on its future earnings and assets. This ownership stake is what gives stocks their value, and it's why the stock market is so important. It provides companies with a way to raise capital for growth and expansion, while giving investors a chance to share in their success. But the stock market is more than just a place to buy and sell. It's a dynamic reflection of the global economy, a barometer of investor sentiment, and a powerful driver of innovation and progress. Understanding how the stock market works is essential for anyone looking to secure their financial future, and it all starts with grasping a few key concepts. In the following sections, we'll demystify the world of stocks, exploring the forces that drive market movements, the different types of investments available, and the steps you can take to begin your journey as an investor. Imagine a bustling marketplace filled with vendors hawking their wares and eager customers looking for a bargain. This, in essence, is how the stock market operates, a constant dance of supply and demand. When more people want to buy a particular stock than sell it, the price goes up. Conversely, when there are more sellers than buyers, the price goes down. This simple principle of supply and demand underpins every transaction in the stock market. But what drives these fluctuations in sentiment? Why do investors suddenly flock to one company while shunning another? The answer lies in a complex interplay of factors, from a company's financial performance and industry trends to broader economic conditions and geopolitical events. Positive news, such as strong earnings reports or promising product launches, can boost investor confidence, leading to increased demand and a rise in stock price. Conversely, negative news, like regulatory hurdles or economic downturns, can spark fear and uncertainty, driving investors to sell their holdings and pushing prices lower. Understanding these dynamics is crucial for navigating the stock market. It's not enough to simply buy into a company because you like their products or services. Successful investors take a measured approach, carefully analyzing a company's fundamentals, assessing its growth potential, and weighing the risks and rewards before making any investment decisions. The stock market is a vast and intricate ecosystem, teeming with a diverse cast of characters, each playing a vital role in its operation. At the heart of this ecosystem are the investors, the individuals and institutions who buy and sell stocks, driving the constant ebb and flow of the market. On one end of the spectrum, we have retail investors, everyday individuals like you and me, who invest their savings in the stock market, hoping to grow their wealth over time. On the other end, we have institutional investors, large organizations such as pension funds, mutual funds, and hedge funds, which manage billions of dollars on behalf of their clients. These institutional giants wield significant market power, their investment decisions capable of moving entire sectors. But investors are just one piece of the puzzle. Facilitating their trades are market makers, specialized firms that provide liquidity to the market by continuously buying and selling stocks, ensuring there's always a buyer for every seller and vice versa. And overseeing this entire ecosystem, ensuring fairness, transparency, and investor protection, are the regulators, government agencies like the Securities and Exchange Commission, SEC, in the United States. Understanding the roles of these key players is essential for grasping the complexities of the stock market. It's a dynamic interplay of individual investors seeking financial security, institutional giants managing vast sums of capital, market makers ensuring smooth trading operations, and regulators safeguarding the integrity of the system. Just like a well-stocked pantry offers a variety of ingredients, the stock market presents investors with a diverse menu of investment options, each with its own unique flavor profile and risk-reward characteristics. The most common type of stock is common stock, which represents ownership in a company and grants shareholders voting rights on corporate matters. When you buy common stock, you're essentially buying a small piece of the company, entitling you to a share of its profits in the form of dividends and potential appreciation in the stock's value. Then there's preferred stock, a hybrid security that combines features of both stocks and bonds. Preferred stockholders have priority over common stockholders when it comes to dividend payments and claims on assets in the event of liquidation. However, they typically don't have voting rights. Beyond these broad categories, stocks can be further classified based on a company's size, industry, growth prospects, and geographical location. From large-cap behemoths to small-cap startups, from technology giants to energy providers, from domestic companies to international conglomerates, the stock market offers a vast array of investment opportunities to suit every risk appetite and financial goal. Understanding the different types of stocks available is crucial for building a diversified portfolio that aligns with your investment objectives. Alright, now that we've covered the basics, it's time to take your first steps as an investor. It might feel a bit overwhelming at first, but don't worry, everyone starts somewhere. The key is to begin with a clear plan and stick to it. First, you'll want to set your investment goals. Are you investing for retirement, saving for a big purchase, or just looking to grow your wealth over time? Knowing your goals will help you determine the right investment strategy for you. Next, it's important to understand your risk tolerance. This means figuring out how much risk you are comfortable taking on. Some investments are riskier than others, but they might offer higher returns. On the other hand, safer investments might grow more slowly. Once you've set your goals and understand your risk tolerance, you can start researching different investment options. Stocks, bonds, mutual funds, and ETFs are just a few of the choices available. Each has its own benefits and risks, so take your time to learn about them. And remember, it's always a good idea to diversify your investments. This means spreading your money across different types of assets to reduce risk. By not putting all your eggs in one basket, you can better protect your portfolio from market ups and downs. Finally, stay informed and keep learning. The investment world is always changing, and staying up to date with the latest news and trends can help you make better decisions. Consider following financial news, reading books, or even taking a course on investing. So take a deep breath and start your investment journey with confidence. With a solid plan, a clear understanding of your goals and risk tolerance, and a commitment to ongoing learning, you'll be well on your way to becoming a successful investor. Investing in the stock market offers numerous benefits. It can help you grow your wealth over time, potentially outpacing inflation. By investing, you also become a part owner of the companies you believe in, sharing in their success. Moreover, dividends from stocks can provide a source of passive income, adding another layer to your financial security. And, let's not forget, investing can diversify your portfolio, spreading out risk across different assets. While the stock market offers potential rewards, it's crucial to understand the risks involved. Market volatility can lead to significant fluctuations in stock prices, which might be unsettling. It's important to remember that investing always involves a degree of risk, including the loss of principal. Diversification is key to managing these risks. Don't put all your eggs in one basket. Additionally, having a long-term perspective can help you weather short-term market downturns. For those just starting out, here are a few practical tips. First, educate yourself. Knowledge is power in the world of investing. Start with a solid foundation by understanding the basics of the stock market. Next, set clear financial goals and determine your risk tolerance. It's also wise to start small. You don't need to invest a large sum of money right away. Lastly, consider consulting with a financial advisor to help guide your decisions and create a balanced investment strategy. Investing is a journey, not a sprint. It's about embracing the process of financial growth and learning along the way. There will be ups and downs, but staying committed to your goals and maintaining a disciplined approach can lead to long-term success. Remember, the stock market is just one tool in your financial toolkit. By staying informed and making thoughtful decisions, you can navigate the path to financial growth with confidence.